The third learning objective is explain the effects on the financial statement of choosing each inventory cost formula. So we just learned the inventory cost formula have three cost formula: specific identification, FIFO, which means first in, first out, and average cost. So you're gonna choose a formula that best represent as closely as possible the physical flow of goods, right? So, for example, our assumption is FIFO, first in, first out. So we are hoping that that's the physical flow, right? When I was a student learning this stuff, they also have a LIFO. It's called last in, first out. Okay, they have another pro. Even today, US is still using LIFO, last in, first out. So that would be appropriate for the milk, right? The last in, first out, right? Customers only pick the most fresh goods. But now in Canada, international financial standard, we do not use LIFO, last in, first out. This method is not allowed anymore. So only FIFO, okay? So here they're not saying it has to be totally match the physical flow of goods. So as closely as possible. In general, okay, for a grocery store, the physical flow of goods would mostly probably first in, first out, right? And sometimes for certain items, right, they're only good for like 2 days or 3 days, right? So in that case, that which one goes first, which one goes last, it doesn't matter that much, right? So because you have a very short time window. So when we compare how the FIFO and the average cost, okay, there are two methods, right? So we want to compare the effect of this different method on the financial statement, okay? So these ones, so for example, if you are in an economic environment that your cost is rising, right? Your cost price is going up, like right now, okay? Because of inflation right now, everything is costing more, right? So, and it's increasing. So if that's the case, okay, if that's the case, so the FIFO will cause a lower cost of goods sold. Why? Because if it's FIFO, right, your ending inventory captures the most recent goods, right? Because the new most recent goods will end up in your ending inventory. Because the price is going up, so those goods you paid at a higher price, okay? So therefore, your inventory would be higher. Your ending inventory would be higher. And therefore, your cost of goods sold should be lower. If your cost of goods sold is lower, your gross profit and net income should be higher. If your net income is higher, your return earnings should be higher. Okay, you see the logic? And then because you are comparing with average cost, right? So then the answer would be the opposite. So it's higher here, then it's lower, it's higher, higher, lower, higher, lower, higher, lower, because you are comparing the two, right? So therefore, if it's higher for one, it will be lower for the other, right? So this is a rising cost. economic environment. It could also be this goods price is dropping down, right? It's going down, the price. So that scenario will be the opposite from the first scenario, because the most recent, the new goods, you pay less money. So the cost is lower, right? The cost is lower. So the inventory is lower. And then cost of goods sold is higher. Profit is lower. Okay, earnings is lower. And then average cost is the opposite of this, is the opposite. If there's no change in cost, right? If the cost always the same, and then you would get the same result, right? So does this make sense? Okay, 1, 2, 3. Give me a thumb up. Does anyone have any question? Okay, thank you. Okay, so let's move on. So this is the slide. It's a summary of the advantage of the cost formulas. So you compare the 3 cost formulas: specific, identification, FIFO, and average cost. What are the advantage? Okay. So specific identification, you keep track of each item, right? Because you have low volumes of inventory, those inventories with normally like larger dollar amount, so you are able to track each of them. Okay. So the ending inventory is reported at the actual cost. So if my ending inventory is left with an antique car, right? So that I know exactly how much I paid for it, that one antique car. So the ending inventory is reported at the actual cost. Okay. FIFO, it approximates the physical flow of goods for most retailers. So for most retailers, FIFO, first in, first out, this assumption would quite logically make sense, reflecting the physical flow of goods for most retailers. Average cost, because you are taking the average, therefore you have a smoothing effect, right? Even though the pricing is like up and down, right? But because you are taking the average, you kind of smoothing it out, right? So you smooth the effect of price changes, okay? It can approximate the physical flow of goods for some companies. So I'm thinking about, let's say if you sell water, right? You have old water, you have new water, and you have a big tank, right? So you cannot almost distinguish which is the old water, which is the new water, because when you put the water in the tank, they all mix together, right? So when they mix together, you can say, oh, this is the old water I purchased. This portion is the new water I purchased. Okay. No, that's not how it works. When you're buying water, you put them into the tank, all the water are mixed, right? So in that case, it's the average cost, right? It's the average cost. Does this make sense? Okay. No, let's move on. The last one. Demonstrate the presentation and analysis of inventory. Okay. So when the net realizable value is less than cost, the value is write down. Okay. So when I was doing the inventory count for my audit client, right? So I walked into the store. I noticed that some of the items are collecting dust. Okay. I can just tell that those items was there for a long time and it hasn't been moved. It's dusted, right? So then I'm questioning how come that item was not sold on time, right? So can you still sell it? So if you haven't sold it for 2 years, are you still able to sell it at the price you want? So I know, you probably have this computer you paid for $500, but it's sitting there for 2 years. Nobody would want to buy it because it's outdated. The technology is obsolete, right? So if I want to buy a computer, I want to buy a new computer, the most recent computer, right? So you have an old computer there collecting dust. You are not able to sell it. Okay. So it costs you $500, but the value of that computer is not $500, right? So let's say you try to sell it to a poor student, you negotiate, you are able to sell it for $300. Okay. So that is your net realizable value. Okay. So the cost is 500. That's how much you pay to get that computer. But for whatever reason, now you're trying to get rid of it. The best price you get is $300. So that $300 is your net realizable value. It's below your cost. So therefore, you should not report $500 on the balance sheet because your inventory does not worth that much. You should report $300. Okay. So when you write down the inventory, okay, you have a loss, right? You have a loss. So the idea is when you value the inventory at the lower of cost and net realizable value. Even though it costs you a lot of money, you should not put a value of that money to your inventory because you just cannot realize that value, right? So how much value you can realize? Oh, I can realize 300. It's less than the cost 500. Then you better report at 300. And the $200, you need to write it off as a inventory loss. Okay. Okay, so on the statement of financial position, which is also the balance sheet, you report inventory at the lower of cost and the net realizable value. In the notes to the statement, you want to tell them the total amount of inventory and what is the cost of goods sold. Okay, because this information will be in the statement of income, but it's good that you disclose here for each inventory. And then the cost formula used. Did you use a specific identification? Did you use FIFO? Did you use average cost? And there's no significant difference between IFRS and ASB. I still have 5 minutes, okay? So inventory turnover, okay? Inventory turnover tells us that how quickly you are able to sell your inventory, okay? How quickly you are able to sell your inventory. So specifically, inventory turnover ratio measures the number of times on average inventory is sold in a period. Days in inventory ratio, this tells you that on average, how long your inventory stayed in a warehouse before it is sold. So how do you calculate inventory turnover? You use your cost of goods sold from the income statement divided by the average inventory, which is beginning inventory and ending inventory divided by 2. Okay, so this gives you the inventory turnover. How do you calculate days in inventory? You use a year, there are 365 days. So you use 365 days divided by inventory turnover. That gives you the days in inventory. Okay, does anyone have any question? Give me a sum up if you understand everything. Awesome.